Hello and welcome to the latest episode of On the Money, a weekly look how to make the most out of your savings and investments. Now, if you invest in or are interested in index funds and exchange traded funds, ETFs, then this episode will hopefully provide you with plenty of food for thought. I recently spoke to Rob Arnott, who is founder of Research Affiliates, about a new approach to investing in the US stock market. So let's get straight to the interview. So Rob, index funds, they've been around since the early 1970s, and the most popular way of tracking the index is on a market capitalization weighted basis. However, you've come up with a new way of investing passively, a new index, which aims to capitalize on one of the main flaws of how most index funds and ETFs operate today. So could you talk us through it?
Well, firstly, it's a privilege to be on this podcast. Thank you for the invitation. You're right in framing it as a flaw. Index funds have been around a long time, and they have a lot of wonderful merits. They're a truly brilliant idea to create those strategies. But they aren't passive. They add stocks, they drop stocks. Stocks that are added tend to be high flyers that are trading at lofty multiples. They tend to be stocks that have been soaring for quite a while and might be a rocket ship running out of fuel. Those stocks replace stocks that might be a merger or an acquisition or a bankruptcy or a discretionary deletion where the index provider decides this stock no longer matters. Now, what does it take for a stock to be deemed too small to matter? Well, firstly, the market capitalization has to be tiny. Secondly, the stock is likely to have been in free fall for a long time. Thirdly, the stock is likely to be trading at a deep discount relative to the market. So one of the things we looked at was that stock additions tend to be 4 times the valuation multiple, 4 times the price earnings, price sales, price to book value of the stocks that are deleted. That means that they have to absolutely perform brilliantly as a business relative to the deletions to justify that valuation differential. You mentioned another element of indexing, capitalization weighting, which is in some ways a little bit of a minor flaw in that you're linking the weight of the stock to its market capitalization, hence cap weighting, and thereby to its price. So the higher the price, the higher the valuation multiple, the bigger the weight. You can have 2 companies that are the same size business, and if one is trading at twice the valuation multiples, it's going to get twice the weight in the index. There's nothing wrong with that if the company does in fact achieve success that in the future that's twice as big, but that's a tall hurdle. And so we pioneered fundamental index back in 2004 to address that issue by weighting companies according to how big they are. Fundamental index corrects that peculiarity of cap-weighted indexing and, very interestingly, introduces an alpha engine, a source of incremental return, because it rebalances. If a stock soars and the fundamentals don't, you're going to say, thanks for that elevated price. I'm going to take my gains and trim it back. If it tanks and its fundamentals don't, fundamental index will say, thanks for the deep discount. I'm going to top you back up. And it's that trading that actually adds an incremental return relative to a style equivalent, value-oriented index.
So the new index that you've come up with, it's seeking to take advantage of companies that have dropped out of an index. And you've put some figures together to show that these companies on average do outperform. Could you explain that?
Yeah, we went back over the last 33 years and looked at Russell 1000, the NASDAQ 100, the S&P 500, and asked what happens with deletions. And what we found was that deletions tend to rebound. Now, in point of fact, over half of them don't rebound. But the ones that do rebound a lot. And the result is that if you look at it as a portfolio, this roster of deletions outperforms the indexes that they were dropped out of by an average of 7% in the first year and a little over 5% per annum for the next 5 years. Well, why not buy that list? Folks love to look for the downtrodden, look for the unloved, and the notion of buying those serves two purposes. One, you're buying cheap stocks. Two, you're buying stocks that have been driven down and are historically likely to outperform. The outperformance on average over the last 33 years was 5% per annum compounded over the first 5 years after deletion.
And does that same trend ring true for other markets, such as the UK or Europe? Have you looked at whether that's the case?
We haven't tested it, but we have tested it in a variety of US indexes, and it works everywhere we've tested it. So I'm highly confident that it would, something that picks up on rejects from the FTSE 100 or the FTSE 300, would very likely see similar outperformance over the subsequent 5 years. Now, keep in mind, it's outperformance adjusted for style. That is to say, you are buying deep value, small capitalization stocks. So the correct comparison is not with the index that it's no longer a member of, but with small cap value. So this is both a way of picking up incremental return and plugging a hole in your portfolio by giving you exposure to what's missing from the indexes by definition, stocks that are indeed small cap, deep value, and not in your portfolio.
And you mentioned that typically half will rebound and half won't.
Yeah.
So how do you separate the winners from the losers? I know there's certain qualities and characteristics that you look for. So could you give us a flavor of what you're looking for?
Well, firstly, those statistics are based on all of the stocks that are deleted. Now, it's fine that half win and half lose if the winners win by a big margin and the losers lose by a smaller margin. It's a portfolio. And the fact that losers sometimes continue to lose. We wrote a white paper called Nixed, the Upside of Getting Dumped. And we used the analogy of, in relationships, people getting dumped and some learning from it and thriving and becoming better people. Others don't. And the same thing happens with companies. You're kicked out of an index. Maybe you go on to thrive and regain past glories. Maybe you don't. The thing is, the initial pricing when they're dropped from the index already reflects bleak expectations. And if the expectations are that the company's a loser and will always be a loser, all they have to do is exceed bleak expectations in order to rise handily. There's a beautiful example of that. Dillard's has been deleted from the Russell 1000. It's been in the Russell 1000 index 4 times in the last 33 years. It's been kicked out 4 times and rejoined 3. The last time it was kicked out was 2017. It's gone up 550% since 2017. Well, that's pretty cool. And our back of the envelope suggests it's going to be re-added to the Russell 1000 again next year, we think. We don't know for sure. But that's a beautiful example. I wrote a paper in 2018 called Buy High and Sell Low with Index Funds. Dillard is bought at a premium when it joins. It's sold at a loss. It's bought at a premium again. It's sold at a loss. Bought at a premium again. Sold at a loss. And it looks likely to be bought again at a premium. That's what the indexes do. We take the other side of those trades.
And the new index which is being created, how many constituents are there? And is the company you just mentioned, Dillard's, is that one stock that you hold?
Dillard's is not in the index anymore because it passed the 5-year threshold. Basically, we will buy stocks that fall out of the top 500 and out of the top 1,000 in the U.S. We will hold them for 5 years. Or if they get readmitted into the top 500 or top 1,000, or if the quality is sufficiently crummy. We don't want value traps. So we exclude stocks that are in the 20% worst quintile of companies ranked by quality. Now, we use a composite measure of quality. In the academic world, people use profitability to measure quality. Well, that's a pretty crude, simple measure. Sure, high profit margin companies are higher quality than low margin companies. But what about debt equity ratio? What about debt coverage ratios? What about the fameux French investment factor? Is the company on a mission to build an empire for the benefit of the management team or for the benefit of shareholders? And so each of these is a constituent part of our measure of quality. Now, if you strip out that bottom quintile, you're stripping out most of the value traps, vast majority. I like to joke that we filter out 10 out of every 3 value traps. And you're also filtering out companies that are struggling, that eventually regain their footing. That's okay. It doesn't hurt the performance to filter out the low-quality companies. It does help the downside. It cushions the downside, and it avoids most of the companies that ultimately go on to ruin.
So if I try to push you on naming a company that you own in the new index that you think will potentially rebound over the next 5 years, which company would you pick?
I would have picked Dillard's, except it's no longer in the index. I don't pay that much attention to what individual companies are in the index. It's got 147 names in it right now. And they're all unloved, deep value companies that have been kicked out. So I don't really cherry pick and look for individual names.
And when you pick them, are you applying the same percentage level to each stock? And then for the ones that go up, are you then taking some profits?
Every year we rebalance back to equal weighting. So if one company doubles and the other company falls in half, firstly, that's good news. If one stock's up 100 and another stock's down 50, that pair of stocks is up. So that's part of the arithmetic of what happens here. But secondly, you then trim this one and top up this one so that you're back to equal weighting. Why equal weighting? Because it gives you a rebalancing alpha. That rebalancing alpha is an important part of our return. Capitalization weighting doesn't give you that. That's ultimately the biggest Achilles heel of cap weighting, is that it leaves a rebalancing alpha on the table.
And with the US markets, we're particularly seeing that risk at the moment, given how strong the performance has been for a small number of US technology companies. Those share prices have sizzled since the start of 2023. Do you see this as being a big risk at the moment for US markets, given they now account for those 7 stocks, the so-called Magnificent Seven, account for just over 30% of the S&P 500 index?
They do. Actually, the 5 largest cap stocks account for 30%. The 7 crested at 37% of the S&P just a few weeks ago. Whoever coined the expression Magnificent Seven clearly didn't see the movie. 4 of the 7 are dead at the end of the movie. Now, which 4 of the 7 Magnificent Seven are going to be dead at the end of the stock market movie, I don't know. But in all seriousness, you've got a roster of companies, all of which are beautiful companies, well-run, great product, beloved by the market, and priced for perfection. There's nothing wrong with those companies. The only thing that's wrong is the stocks are priced to reflect rates of future growth that are implausible.
And why do you think it is that the market capitalization weighted approach is just so much more popular than, say, an equally weighted approach?
Well, the narrative behind it, I knew Jack Bogle reasonably well, and he said, forget about EMH, efficient markets hypothesis. What matters is the CMH, the costs matter hypothesis. By running it as a capitalization-weighted index, firstly, you have very, very low turnover. There's no rebalancing going on at all. The only turnover is companies coming in or going out. Secondly, because the management process for the portfolio involves so little trading, the fees can be very, very low. Some index funds in the U.S. charge 0. The companies that have sponsored these ETFs and index funds aren't in a business of charitable providing of product for nothing. So they make money on securities lending and other ancillary benefits. But the costs do matter, and they're very, very low. If you want to own the market, if you take a view that I don't know what stocks are going to go up or going to go down, I don't have confidence that I'm smarter than the market, let me just own the market, then you will cap weight. But you will own the whole market, including thin, illiquid, tiny companies. You won't kick out deletions. And so the deletions serve a role to fill in those gaps. so that if you have an S&P or a Russell index fund, a deletion strategy can fill in those gaps and do it in a smart way, not just picking up all of the little companies that are out there, but picking up companies that were once successful and may be again.
Thank you for listening to this episode of On the Money. If you enjoyed it, please leave us a rating or a review and follow the show in your podcast app. And if you get a chance, tell a friend about it too. You can join the conversation, ask questions and tell us what you would like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, which is ii.co.uk. See you next week.